The homes with those very low rates now have increased in value, and our veterans have started paying down their loans. So what that means is they bought a house for $500,000. They funded the whole thing, so the original loan was $500,000. Now the house is worth $700,000, but the loan amount is $495,000. What that means is the only amount that the new buyer can assume is $495,000.
Yep.
So we have a gap of $205,000 that needs to be covered to purchase at $700,000. How do we do that?
Mom and dad.
What do we do? Could be mom and dad. Maybe they do have down payment money that they were going to use on a conventional loan. So maybe it's there. Maybe they get a gift, or in some circumstances, you could try and get a second mortgage to cover that gap, or sort of almost like a home equity loan.
So like the bridge loan is sort of like, how much is now the interest rate for the people, so they won't
So that
expect-
becomes the issue. The issue is that now you're going to have what we call a blended rate for the total mortgage amount.
Yeah.
So the bigger that gap and the more that you're putting into the second rate, and that second, because it's in the second position and therefore is more risky, that interest rate is higher than the current interest rate.
Do
So
you
not
know-
only, so you're not going from 3% to now we're at 6%, you're actually going to 8%.
8%.
So when you blend that rate, it might not make sense to actually assume the loan.
Yeah,
But in many
absolutely.
cases it does.